OpenAI is projected to face a $14 billion loss in 2026, according to leaked financial documents. So the question is, what is driving these staggering losses? And how might this impact the company's rumored IPO planned for 2027? Let's solve this equation. What's happening, capital trackers? Welcome to the resource equation, where we don't predict markets, we understand them. If you're new here, hit subscribe. We break down the week's biggest macro moves with zero hype, just facts. OpenAI, the AI research lab behind ChatGPT, is reportedly on track to lose $14 billion in 2026. This projection comes amid rapid expansion in AI infrastructure, including data centers and computing power required to train and run its advanced models. The company's spending on compute alone is estimated at $1.4 billion annually, with total losses expected to nearly triple from 2025's $5 billion deficit. These figures emerge as OpenAI continues to scale its AI offerings, including the recent launch of its video tool, Sora 2, which reportedly costs $15 million per day to operate. Why does this matter? OpenAI's losses are largely driven by soaring infrastructure and research costs, including hiring top-tier talent and maintaining competitive advantages in an increasingly crowded AI market. Training large language models requires immense computational resources, and as the models improve, the cost and energy demands grow exponentially. According to Deutsche Bank, OpenAI could accumulate $143 billion in cumulative losses before achieving profitability, a scale of negative cash flow unprecedented in startup history. This raises questions about the sustainability of OpenAI's current growth strategy and its ability to balance innovation with financial discipline. Here's where it gets interesting. Three numbers tell the story. First, $14 billion projected losses in 2026. Second, $13 billion in estimated annual revenue from ChatGPT subscriptions and licensing. And here's the kicker. OpenAI's expenses, including stock compensation and compute, continue to outpace revenue growth, with some reports suggesting cash reserves could run dry by mid-2020s. Despite recent funding rounds that raised $6.6 billion and a credit facility exceeding $4 billion, the company faces pressure to establish a clear path to profitability, especially ahead of its rumored 2027's initial public offering. Surface level, OpenAI's leadership remains optimistic. CEO Sam Altman has dismissed concerns about an AI bubble and emphasized steep revenue growth, projecting revenues could surge to $100 billion by 2027. However, market analysts and financial experts remain cautious. Tom's Hardware and economist Sebastian Mallaby from the Council on Foreign Relations highlight the challenge of closing the gap between soaring costs and revenue. Even with potential strategic shifts or capital raises, the financial outlook remains uncertain. Pause here. Does this make sense? Drop your take in the comments. Digging deeper, OpenAI's challenges are not only financial. The company faces user backlash over the integration of ads into ChatGPT, a lawsuit from Elon Musk alleging broken promises about non-profit commitments, and significant internal turmoil. Key executives, including CTO Mira Murati and Chief Scientist Ilya Sutskever, have departed, and product releases like GPT-5 have faced criticism for underwhelming performance, forcing OpenAI to revert to older versions. Meanwhile, competitors like Google's Gemini platform are gaining traction, with Gemini reportedly reaching 650 million monthly users, intensifying the competitive pressure. Remember that question about what is driving OpenAI's losses? We're getting closer. Financially, OpenAI's spending on AI development is staggering. Reports indicate the company will spend more than $200 billion through the end of the decade, excluding stock compensation costs, which alone accounted for $15 billion in the first half of this year. Roughly 60 to 80% of annual expenditures go toward training and running AI models. The economics of improving AI models are becoming increasingly challenging, with each incremental improvement requiring exponentially more compute power and energy. OpenAI's own lead engineer has described the economics of tools like Sora as completely unsustainable. Real talk. What's your hypothesis on why OpenAI made these investment decisions despite mounting losses? Back to our opening question. Here's what we now know. OpenAI's projected $14 billion loss in 2026 reflects a combination of aggressive infrastructure expansion, high compute and energy costs, and ongoing investments in research and development. While the company generates significant revenue from ChatGPT and related services, those earnings currently fall short of covering its expenses. The path to profitability remains unclear, especially with ongoing legal challenges and leadership changes adding complexity. What comes next? OpenAI's rumored IPO in 2027 will be a key milestone to watch. Additionally, the lawsuit filed by Elon Musk, valued at $134 billion, is set for trial in April 2020 and could have significant implications. Financial markets will also be monitoring OpenAI's ability to manage its cash burn and secure further funding rounds, as investor appetite appears to be cooling amid growing concerns about the AI sector's sustainability. How do you interpret this? Who gets affected most by OpenAI's financial trajectory? What signals are you watching in the AI industry? Let me know in the comments. And if you found this valuable, hit that like button. Okay, stop. Rewind for a second. Here's the number that changes everything. Microsoft disclosed that OpenAI burned through $12 billion in a single quarter, underscoring the immense scale of its cash outflows. Deutsche Bank's projection of $143 billion in cumulative losses before profit further emphasizes the unprecedented financial stakes involved. Now, while OpenAI's financial health grabs headlines, there's another equation being solved in real time. Elon Musk confirms SpaceX IPO 2026 complete breakdown. If you think today's story matters, you need to see what we uncovered there. Link in the description. Watch it next. Subscribe to the Resource Equation for weekly breakdowns like this. Next up, how emerging AI regulations could reshape the tech landscape. See you in the next one. Quick reminder, this video reports and explains public information. It does not offer investment advice.